If you're raising capital from passive investors, then you got to understand that you're selling securities. Anytime you're taking money from passive investors where you're generating the returns, you're selling securities. And so at that point, I always tell people there's really only three things that you need to think about. Number one is you either have to register that security, that syndication with the SEC, the Securities and Exchange Commission, which we never want to do, or we got to find an exemption to that registration, or it's illegal. Those are your three options. So we don't want to register because that's like going public, IPO, which we're not going to do. We definitely don't want to do anything illegal. So we're always looking for what's the right exemption, right? And there's a couple popular ones, not to get in the weeds. I know, Open Door Capital, we use 506C, which allows Open Door Capital to advertise and basically market their securities through the internet, through events or whatever. And then you're just limited to accredited investors only. So if you're listening to this, I'm like, I'm not accredited, I want to invest with Open Door. That's why you can't, because the exemption doesn't allow you. Or the other popular is a 506B as in boy, which does allow you to take some non-accredited, but it prohibits you from advertising. So that doesn't really fit.
Which is why I chose a C.
Yeah. So
I feel like Bs were way more popular.
Oh, between the two, 90% of those two will go to Bs and only 10%
even
to
today
Cs.
still?
Even today,
Really
still.
fascinating.
Because there's a verification process for if you're doing a C. So you not only have to, you can't just take their word for it. You got to take what's called reasonable steps to verify. Usually, an easy way to do that is to have the CPA over here verify, but a lot of CPAs just don't want that liability. So it's harder and harder and harder these days to get that verification. So then it's like, don't look at your tax returns, and just high net worth individuals, if they have a choice between those two, tend to like, I don't want to give you my tax returns and my financials. But if you have an audience, obviously like you do, or all of my clients that are have an audience, have a YouTube presence or a podcast or whatever, then it's a no-brainer to go 506C because you can advertise. You can scream from the top of of the mountain, and you can take an ad out in the Super Bowl or the Goodyear blimp or whatever. So that works for that. But if you don't have that and you're just starting out and you're relying on friends and family, inevitably, Aunt Karen, Uncle Pete, they're gonna be non-accredited. So you're probably gonna get quote unquote stuck doing a 506B, which is great. You just can't advertise. So you really need to keep that because they're friends and family and people you have a pre-existing relationship with.
Perfect. Amanda, anything to add on that one?
From the tax strategy side, syndications are the same as a single family investor, right? I mean, we're just talking about larger numbers. So I was taking depreciation on a $100,000 property. Now I have depreciation on $100 million property, right? So it's just the scale, but the strategies and the rules are all exactly the same.
So if you enjoyed this clip and you want to see the entire episode, click here. And if you want to see other videos similar to this, click here.